Hey, listen up. You need to know this strategy. This is how wealth building is created. You have to understand active income versus passive income. All right? Because both of these different types of incomes are looked at by the IRS in a significantly different way. So let me first explain to you which one's which. So active income, this is your earned income. Okay? This is typically going to be at your tax bracket that you're taxed at. Okay, so when you're a W-2 job, when you go to your 9-to-5 job, any of your earned income, your side hustles, all those things, that's active income, and that's going to be at your tax bracket. Okay. Now, to understand what tax bracket you'd be at, it's based off your status, whether you're single, married, how much income you make, and then that determines that at. So now, passive income. Okay, that is income that is not earned or that you're not working for. Okay, so that's rental income. Okay, so this is classified in a completely different way. All right, now why does that matter to you as someone that's getting into real estate, maybe has real estate, figuring out what type of niche? Okay, so I do buy and hold investments. Okay, I buy and hold my properties because I want my rental income to be passive. Okay, and I'm going to go through exactly how the IRS depicts both the passive income and the active income and why it matters to you. All right, so when you think of active income, all right, when it comes to real estate, you need to be thinking, right, your wholesalers, okay, your flippers, things like that. It's basically people that are getting in and out, trying to get this quick money, and it's typically looked at if you're making that money within the 12-month time period. Now, the second that you have a rental property, instead of flipping it and wholesaling it, you own it for 12 months and you're making monthly rental income, now it's become passive. Okay, so why does it matter to you? All right, so let me actually take you through one scenario and how that's going to impact how much money you make. Okay, because this is what the wealthy do. This is what the wealthy understand. Because at the end of the day, it's a tax game. Okay, so let's say that you are doing a flip. Okay, and we're going to do buy and hold. Why would you care? Okay, so let's say in this scenario, to make the number simple, you make in 1 year $100,000 profit on a flip. But that same property, you buy and hold and you're renting it and you make $100,000. Just for simplicity, okay? All right, now, it's important to understand. This is active income, okay? So this is gonna be at your tax bracket. So let's say your tax bracket's 40%. So right off the top of your $100,000 that you made, you have to pay taxes of $40,000. Off the top. Uncle Sam gets that. Whereas if this was passive income and you're buy and hold, okay, it's at the lowest tax bracket. It's like 19.5%, but for simple numbers, we'll put 20%. All right, so now I only have to pay $20,000, okay? Right off the top, I made an extra $20,000 just because this was a passive income rather than an active income. So there, I just made $20,000 more just in the type of investment that I have. Now, on top of that, there's also a resource that the IRS looks at. It's called depreciation, okay? So if you actually have a house, okay, all right, what happens is you get to depreciate this value of this property, okay, because it's passive income. So over 27 and a half years of this $500,000 house, whatever it is, okay, I actually get to write off part of this property of $500,000 every year. So I don't know the exact number, but let's say you get to depreciate this asset $10,000 every single year. Okay. You then get to remove $10,000 off of this $100,000 originally. So instead of you making $90,000, the IRS looks at it as you making $90,000 instead, and then you're going to be taxed on that. So your tax liability is even less than $20,000. That's just another benefit that you get, having a passive income that's generating month over month income, where you get a lower tax bracket and you get to depreciate that asset. Whereas if you had the active income, okay, now you're at the highest tax bracket, paying the most taxes, and you don't have the residual coming month over month. All right, so it's important to understand that everyone that's doing the wholesaling, the flips, all right, those quick money grabs, even real estate agents, they're trying to earn income over here. okay? So they can get over here because they know the wealth is actually made in the passive income, all right? So it's important to understand everyone that's doing this wants to be over here. So the quicker you can generate that passive income, the quicker you're gonna be able to generate more income and be able to keep more money in your pocket. So that's why I buy and hold. That's why I buy and hold from the get-go. So you wanna make money and you wanna put into a passive income asset so you can reduce that liability, depreciate that asset, and ultimately make more money that stays in your pocket and out of the IRS's pocket.